Hello, everyone. My name is Fadi Amin. I'm the office managing partner of the Montreal office of Miller Thomson. Je suis l'associé directeur du bureau de Montréal, Miller Thomson. Vous êtes les bienvenus chez nous aujourd'hui dans la mezzanine du Mille de la Gauchetière. Thank you for being with us today. I am very happy to be welcoming you at this Sustainable Development ESG conference. And I'm very happy to be presenting you our panelists today with our host, Bruno Caron, who's co-chair of the ESG group. So without further ado, I want to present to you Monsieur Olivier Giardot. Excuse me. Monsieur Olivier Giardot, Director of Sustainable Finance, Oversight and Supervision of the Autorité des marchés financiers. Olivier Giardot is a Director of Sustainable Finance, Oversight and Supervision of the Autorité des marchés financiers, the IMF. He has led for the IMF several significant policy initiatives dealing with corporate environmental, social, and governance disclosure, including the CSA proposed National Instrument 51-107, disclosure of climate-related matters, and the CSA Staff Notice 81-334. ESG-related investment fund disclosure. He is a member of the IOSCO's Sustainable Finance Task Force. Olivier was previously a staff member within the Corporate Finance branch and the Investment Funds branch, where he was involved in various aspects of securities regulation, including prospectus and continuous disclosure reviews and applications for exemptive relief. Prior to joining the IMF, Olivier practiced corporate and securities law. He obtained his law degree from the Université de Montréal and completed his certificate in securities law and practice from New York University, as well as the IOSCO PIFS Harvard Law School Global Certificate Program for Regulators of Securities Markets. Also, we have Ian Charret, Senior Director, Treasury, Caisse de dépôt et placement du Québec. Ian is a leading CDPQ Treasury team, which is responsible for the organization's funding programs, funding planning, and liquidity management. He joined CDPQ in 2013, holding several roles in treasury management and finance. Prior to CDPQ, Ian spent 10 years at Laurentian Bank of Canada, holding different roles dedicated to liquidity, funding, and capital management. Ian holds a Bachelor of Economics from University of Montreal, a Master of Finance from HEC Montréal, as well as a Chartered Financial Analyst CFA certification. Bernard Blouin, he's a partner in a corporate finance and capital markets group at Miller Thomson. He practices business law. He was the managing partner of the Montreal office from 2015 to 2016, and Miller Thomson's practice group chair business law from 2017 to 2019. With more than 25 years of experience in corporate finance, venture capital, and commercial law, Bernard's practice focuses on public sector debt financing, securities, venture capital, financing, and mergers and acquisitions. He regularly represents debt issuers in their transactions on various markets worldwide. He also has extensive experience advising banks and financial institutions regarding various financing deals. As part of his practice, Bernard has been an advisor to several technology companies on takeover bids and mergers and acquisitions in the United States and Canada. Furthermore, he represents many fast-growing high-tech companies. Finally, Jason Croft. He's co-chair of the ESG and Carbon Finance and co-leader of the Structure Finance and Securitization practice, Miller Thomson. Jason he is a leader at the firm in respect of carbon finance, ESG, sustainable and green finance. Jason routinely acts for a diverse range of carbon markets participants, including project developers and sponsors, lenders and other financial institutions, carbon brokers and traders. Jason advises boards of directors, C-suite executives, executive leadership teams, chief legal officers, general counsels, chief sustainability officers, risk management teams, and business managers in developing and implementing strategies to consider, manage, and report on challenges and opportunities related to ESG and carbon finance and sustainability in general. He provides clients with practical, timely, and effective counsel and support, bringing over 25 years of experience and a unique perspective in innovative and specialized finance transactions to facilitate complex and cutting-edge deals. Jason is also a prolific author and speaker, having published and presented on such subjects as responsible investing, green and sustainable finance, structured products and finance, securitization, and derivatives. As a former adjunct professor at Osgood Hall Law School, he lectured and taught courses in business and legal topics and chaired the Osgood Hall Law School Pro Bono Business Law Clinic while at his former law firm, the longest-running pro bono law clinic in Canada. And lastly, I want to represent to you Bruno Caro, co-chair of the group as well, and who's going to be your host for the rest of the day. Thank you. Merci, Bruno.
Alors, merci Fadi. Bonjour à tous. Bienvenue à notre deuxième événement 2023 du Groupe national de la responsabilité sociale des entreprises et du marché du carbone. Mon nom est Bruno Caron et je serai votre animateur aujourd'hui. Je vais maintenant m'adresser à vous en anglais puisque l'événement, comme vous pouvez le noter, est aujourd'hui rediffusé en direct à travers le Canada et qu'il est enregistré pour rediffusion sur le site web du cabinet pour une consultation ultérieure. So welcome all. My name is Bruno Caron and I will be your host for this lunch hour. And we are very proud to have assembled for you this expert panel and are especially grateful for the presence of Olivier and Ian, and I would like to extend to them our warmest welcome. So before we start, let me handle some housekeeping matters. First, there will be a Q&A session at the end of the event, and we encourage you to put your question through the online chat for people who are attending virtually or in person. And my colleague, Leah, at the back of the room, will circulate with a mic so that everyone can hear your question. Second, this event is accredited for 1 hour of continuing professional development for lawyers in the room in Quebec and Ontario, and will be accredited in Saskatchewan and British Columbia. And confirmation of the CPD hours will be sent to each of you in our electronic thank you note. So let's begin. As net zero goes mainstream, sustainable finance is being increasingly recognized for its critical role in supporting the action needed to combat, among other issues, climate change. According to the United Nations Environment Programme Financial Initiative 2023 Climate Risk Landscape, to fill the financing gap under the Paris Agreement for both mitigation and adaptation, developed countries like Canada will need to provide at least in US dollar $100 billion a year in climate capital. For their part, developing countries are facing adaptation costs of up to $340 billion per year by 2030, increasing to $565 billion per year by 2050. This is in addition to mitigation costs of up to $850 billion per year by 2030. So consequently, a lot of sustainable finance will need to occur to satisfy this intense capital need. Having set the table, let's begin with our first panelist, Olivier Girardot, with an overview of the Canadian regulatory landscape applicable to sustainable finance. So Olivier, my question to you, what regulatory developments are expected from the CSA in the area of sustainable finance in the near term? And by near term, I mean by the end of 2025.
Yeah, sure. Well, first of all, thank you, Bruno, for the invitation, and thank you, everyone, to attending our session today. Really look forward to having a meaningful discussion with each of you and with my fellow panelists. Before I begin, of course, I need to provide our standard disclaimer. So any view that I will express today are my own and do not necessarily represent the view of the Canadian Securities Administrator, the QAMF, or the respective staff. So in terms of specific initiative related to ESG initiative, in June of last year, the CSA released its 2022-2025 business plan. And these 3-year business plans really represent the collective effort by the CSA members to set out in a clear and comprehensive manner our priorities for the coming 3 years. The CSA business plans cover more than 30 initiatives. Some of them are operational, others are policy-led initiatives. And 4 of them are more particularly focused on ESG issues. The first one, and is without surprise, is to finalize our climate change-related disclosure requirement for reporting issuers. I think we've had the chance to talk about it a little bit later in the panel today, but we want to pursue climate change disclosure based on the comment we receive on our proposed National Instrument 51107. The second initiative is to consider a diversity disclosure and related governance issue. So we want to consider potential next steps to incorporate broader diversity in the CSA disclosure framework, building on the previous disclosure requirement and guidance with respect to women on board and in an executive officer position. And on that specific initiative, I would like to highlight the fact that we published, in fact, 3 weeks ago on April 13, our draft amendment to the current disclosure framework for diversity. And we are currently live on a consultation period, and the consultation period will end on July 12, 2023. The third initiative I like to highlight is that we will continue to monitor ESG-related investment fund disclosure. So back in January 2022, we published guidance related to ESG-related information to be published by investment funds. So since then, we want to continue to monitor the disclosure in regulatory documents and sales communication of investment funds with investment objective that specifically reference ESG factor or that markets themselves as ESG or sustainable funds, and other funds that use ESG strategy to ensure compliance with the guidance that we published last year. And the last initiative, but very an important one, is to better incorporate Indigenous people issue and perspective into the CSA policy work. So we set up a task force on Indigenous people in the capital markets with the aim on enhancing consideration of Indigenous people and communities and try to work to integrate this consideration in relevant area of securities regulation and CSA policy work and try to find a way to improve how we engage with Indigenous groups going forward in our policy initiatives.
Thank you, Olivier. I think that's a very good overview of what you've been working on. Let's now focus more on climate change. You've mentioned Draft National Instrument 51107 on climate-related disclosure, which was published back in October 2021.
Yeah.
Is it possible to get a more detailed update on the CSA's work on the issue and what are the next steps? Because for us practitioners, that's crucial to be able to advise our clients.
Yeah, for sure. And I think that it can be a lengthy discussion, so I'll try to give you as much as insight as I can, given the relative time frame we have. So maybe it's worth mentioning from the outset that as a securities regulator, our focus is really on the financial materiality and the risk and opportunity facing public company. That is what is relevant to the price of securities, and that is why we propose to publish Draft National Instrument 51107. The proposed instrument we published October 2021 contemplate disclosure that were largely consistent with the 4 TCFD recommendation pillar, being governance, strategy, risk management, and then metrics and targets. While the proposed instrument aligned with the core element of the TCFD recommendation, it did offer companies some flexibility in specific disclosure. Specifically, the proposed instrument did not require at that time scenario analysis, and it contemplated disclosure of GHG emission on a comply or explain basis. The comment period closed on February 16, 2022, and we received over 131 comment letters. So for a CSA public consultation, that's quite a lot. The letter comes from a wide variety of stakeholders, including 24 investors and other users of disclosure, 29 public companies, and then 18 industry associations. Overall, and it's worth noting it, most commenters were supporting of the proposed instrument and aligning Canadian companies with the growing international convergence toward the TCFD recommendation. One of the bigger picture comment that we received was, of course, to urge consistency with the future standard at that time proposed by the ISSB, the International Sustainability Standard Board, or the eventual proposal at that time of the SEC rule to support comparability among companies globally on a global base. Another recurring theme in the feedback was related to our venture market, given that, of course, three-quarters of public companies are listed in Canada on venture exchange. We heard from stakeholders that sometimes more recommendations are needed for these small company and venture issuer, and that could take the form of, for example, a longer phase-in period, allowing a comply or explain approach for more climate-related disclosure, or again, that it could be completely exempted from some of all the requirements of the proposed instrument. One of the other key aspects of the feedback is that a significant number of commenters, especially those that are not public companies, believe that there should be more mandatory requirements. The overwhelming majority of commenters supported mandatory scope 1 and 2 of GHG emission disclosure, where about half of public companies that commented supported the comply or explain model that we proposed back then. It is fair to say on scope 3 GHG emission that feedback was wide and very, very varied in nature. As you all know, in October 2022, the CSA released a press release, which in a sense stated that a lot of global developments has happened since we published our proposal for comment, and that has caused us to take a stock and look at those developments and consider how they may impact our proposal. We wanted to let the market know that we will not have a final rule by the end of 2022, but we were not ready to signal at that time the direction of travel for future timing. The three main developments that are informing the CSA work are, of course, the work of the ISSB, then the establishment of a Canadian Sustainability Standard Board, or CSSB, and finally the climate-related disclosure proposal published for comment by the SEC in March 2022. Starting with the ISSB, we have done a deep dive analysis into the ISSB exposure draft published for comment last year, and the CSA submitted a comment letter to the ISSB on its consultation. In very general terms, of course, while both the CSA proposal and the ISSB exposure draft are based on the 4 pillars of disclosure TCFD recommendation, the ISSB exposure draft are much more prescriptive and much more detailed. That's what we propose. We also reviewed the feedback from Canadian stakeholders on the exposure draft and note a few key themes over there. There was, interesting to note, more than 96 commenters from Canadian stakeholders that participate in the ISSB international consultation. Canadian commenters generally support the establishment of a global baseline. However, many commenters raise concern regarding the requirement for scope 3 GHG emission. Many commenters note that it is important to scale and or phase in disclosure requirement to accommodate the needs and capabilities of companies of various size. Since then, we are, of course, following very closely the ISSB deliberation and tentative decision. And on that note, I don't know if you have taken note of that, but the ISSB has confirmed that the standard will be published in the final form in June 2023, and they will be ready for use as early as January 2024. And since the beginning, consists of time, the CSA strongly support ISSB state objective of developing a comprehensive global baseline, and we then will continue to follow the work and make ourselves, a determination with the final rule. I think it's also important to raise a second development, that is the creation of a Canadian Sustainability Standard Board. And why it is important? First of all, the CSA, in a letter sent March 2022, supports the creation of the CSSB. And the CSSB will enhance Canada's already well-regarded reputation in international standard setting, while providing a key platform for consolidating and putting local perspective into the international processes. The CSSB will be similar to how we have a domestic accounting standard board and auditing and insurance standard board for Canada. Those existing boards and the mechanism used to bring international standard to force for Canadian use. For securities regulatory purposes, we are still considering how best incorporate sustainability standards into our rules, but certainly the CSSB will be a strong factor for consideration. Work is well on the way to establish the CSSB, and in fact, last month in April, the CSSB named its chair, which is Charles-Antoine Saint-Jean. So with the CSA already engaged with the CSSB, and the CSSB should be operationalized by June 2023 as well. Finally, the last development that I will touch very briefly upon is, of course, the SEC own proposal on climate disclosure. So, of course, we get a deep dive analysis of the proposal of the SEC. We also analyze all the feedback received from Canadian stakeholders. The SEC received more than 37 comment letters from Canadian stakeholders. We found that Canadian commenters, many of which were dual-listed companies, generally focus on the preservation of the access to the MGDS, the multi-jurisdictional disclosure system, so that eligible Canadian companies could comply with Canadian climate-related disclosure requirement. Of course, we are still mindful of the risk of regulatory fragmentation in the North American market operates differently, and regulatory coherence is the goal. In terms of what next, maybe really briefly, the SEC 2023 regulatory agenda indicated that they were aiming to publish their final rule in April 2023. Well, it didn't materialize. So we're now expecting that they will be making, of course, some adjustment to their rule in response to the stakeholder feedback that they receive. As I highlighted, the CSSB, which will probably the vehicle through which the ISSB standards are brought to Canada, is expected to be fully operational by June. And the ISSB, as indicated, they will publish their final standard by June 2023 as well. As I mentioned earlier, the CSA remains committed to supporting a global baseline and international coherence for climate-related disclosure. But since most Canadian public listed companies are microcap, our regulation are tied to suit companies of different size. So of course, if the CSSB or the ISSB final standards incorporate sufficient flexibility to achieve compliance by company of various size, that will help support the adoption of the standard by the CSA.
And I can tell you that attending the first symposium of ISSB in February in Montreal, which the firm sponsored, by the way, is one of the hot topic about the scalability of S2. And so we'll see. But I take it that until 2024, because the SEC has indicated that we will probably not see a climate rule in 2023. So I take it that we'll have to wait for 2024 for some development with respect to 51107. Next question. We've talked a lot about disclosure. Let's now address the issuance side of things. Do you think that a specific instrument aimed at regulating what in our jargon we call the GSSS, which is the green, sustainability, social, and sustainability-linked bonds, is desirable in Canada?
Well, I think it's an interesting question for which I will unfortunately not have a definitive answer yet as of today, and I will be very curious to see what are the idea of my fellow panelists on that subject. And as I present our CSA business plans for 2022-2025, of course, it was not necessarily an initiative that we prioritized at that moment. Having said that, it's something that, of course, is on our radar screen, at least within the QIMF. And in the same way, we would like, for example, to take in a future more closer look at the issues related to ESG data and rating provider, for example. Maybe at high level, very few preliminary thoughts on the subject. I think that at the end of the day, we'll necessarily have to have a balanced approach if we go in that direction. What I mean by that balanced approach is that one that helps to minimize the risk of greenwashing, of course, but also allow sufficient capital to be allocated for the transition, for example. I'm most certainly the last one who would like an over-rigorous framework to prevent us from attracting the capital needed to decarbonize our economy. Having said that, there's different regulatory tools that we can use as a securities authority. One of them is to issue guidance throughout a staff notice. As you mentioned in my presentation, we work on that front from ESG-related, investment funds, ESG-related disclosure, from which we require better disclosure through guidance. We can also talk about eventual, strict regulatory framework. And I will just end by mentioning that, usually speaking, I like to remember that before proposing National Instrument 51107 that we published October 2021, in fact, the CSA published 3 staff notices prior to that on environmental disclosure, and the first one being issued as fast as 2010. So I think on that front, it's something that we'll need to stay tuned to that, but didn't have any public plans to announce today on that front.
Well, thank you, Olivier. I think that was very informative. Let's now move away from the regulatory discussion and discuss more the ins and outs of putting in place a green bond program with Ian. So Ian, putting in place a green bond program requires a lot of coordination between the Treasury, Finance, and other departments within the organization, for example, the sustainability department. Can you describe to us the groundwork that was undergone by the case prior to releasing its green bond framework and its inaugural green bond issuance in 2021?
Sure, absolutely. Thank you for having me. Really happy to be here. Maybe a quick word on, perhaps for people who would be less familiar with CDPQ. Just as a reminder, we're a public asset manager. We serve public and parapublic organizations in Quebec. Most of them are pension funds in the public sector. We have other type of schemes, and we manage a $400 billion portfolio for them as of today. This was my quick introduction for my employer. So to your question, perhaps I can start with more of an overview, a very general picture of the broader context in which our green bond program was implemented. We're an investor, first and foremost. Of course, we have funding programs. We issue debt. That's why I'm here. I'm in charge of the treasury team, so we oversee the funding programs. But we wanted to contribute to a larger strategy. So back in 2017, we adopted climate strategy, and it was kind of unique. Still is, but back then we were the first of our kind to adopt these very explicit and substantive threshold to reduce our carbon footprint. I mean, our investment portfolio, but also to contribute into decarbonizing the real economy. So that's two slightly different things. So we had four main goals and thresholds. The first one was the carbon intensity of our portfolios. That's tons of CO2 per dollar invested. We wanted to reduce that significantly, by 60% to be precise, by the year 2030. Then we wanted to triple the size of our green asset portfolio. That is assets like renewable energy projects or clean transportation. The third pillar, an important one, was to be active in the transition effort. So we set up a $10 billion envelope to invest in transition projects in high emission sectors. That's really our role of engaging with portfolio companies to make a difference. And the fourth pillar was exiting from the oil production sector. So I think it's fair to say we've been fairly successful so far. We had to actually revise upward our threshold 2 years ago. And one of the reasons I think
which is good news.
It is absolutely good news. And I was about to say, actually, one of the reasons I think it was successful is because these ESG, sustainable investment criteria, were integrated in every steps of the investment decision process, from the initial analysis to performance and compensation. So our investment teams, they all have a carbon budget, and their own individual compensation is actually linked to their performance relative to that carbon budget. So that's one of the key factor of success, I think. And obviously, as it is the case with a lot of investors now, we target a carbon neutral portfolio by the year 2050. Sorry for the long detour, but going back to the core of your question about our green bond framework. So the first step we had to take was actually decide what we want to do with that. Sounds obvious, but the scope of that framework. So we decided that from the onset, we want a very clear, transparent framework that would appeal to the most, I guess, the strictest green investors, the dark green investors, I would call them, to broaden the investor base. And the idea was actually to capitalize a lot on our comparative advantage as an investor. We have and we will continue to have large green assets that we can partially fund with these green bond issuances. The alternative would have been to maybe opt for a more general framework, like a sustainable bond framework, which is not bad at all, far from it. I don't want to criticize that, but this is a bit less aligned with our core mission as an investor that has to optimize returns for its clients. We're not a government agency, so we won't, for example, have sizable assets that have a social impact like social housing, for example. It's a bit different. So far, I think we're satisfied with what we've done with that framework. We've issued 2 green bonds so far. We were able to reach out to a pretty large investor base with that framework. And on the process itself, as you alluded to, it's really a orchestration of several teams internally and externally. The first, I think, involved party is actually an expert advisory bank that we had to choose to make sure we designed that framework properly, and that framework will stand the test of time. That we want to make sure it's always aligned with the best practice, and including the green bond principles. So we hired a French-based bank to help us do that. And then the next step was to work with an independent firm that will provide a second-party opinion to attest that this framework is credible, impactful, and aligned with the best principles, including green bond principles. And then there's several others, external parties like, I don't counsel, obviously, but external auditors that will provide comfort on the use of proceeds and so on. And internally, several teams, but including, of course, sustainable investment teams, accounting, legal, communication. But I think they were mobilized because of the cause and because of the ultimate objective. I think we had a fairly high level of mobilization, and Yannick can confirm. I think he was in charge of coordinating all of this effort.
It's the feel good factor.
Yeah, to a certain extent. So that helped a lot. So in the end, I think it took like a few months, right? A few months to implement. We were not in a hurry. We wanted to do things properly. So yeah, that's a general overview of the process of implementing our framework.
People will think I have a fixation on sustainability-linked bonds. I heard that you went green, you discarded social, but the question is, do you think the cash should go on because you've talked about transition, the need for transition? Do you think the cash should go and take the road of sustainability-linked bonds at one point?
It's just to be clear. Social and governance, sustainable investment orientations are very important. They're important from an organization standpoint, just to be completely clear. But in terms of asset under management, that may lend a little bit less to a program where we have to issue benchmark size bonds, like typically $1 billion or more, just to be completely clear. And as to sustainability linked bonds, I think it's an very interesting development, especially on the transition aspect of things. Since we have a $10 billion envelope that we'll use progressively to inject capital in these transition projects, an SLB could be an interesting instrument to channel capital to these projects. Obviously, there's probably 2 things we need to see first. The first condition is enough projects, obviously. Again, we issue typically $1 billion benchmark size or more. So we have to have a usage of our envelope at a higher level than today. And the second condition is probably seeing more standardization, market standardization on that specific segment, especially in the area where we're active, the SSA, so typical of a governmental agencies market. Would like to see some of our larger peers issue that kind of bond. And we don't want to be a late adopter, but we need to see more, I guess, precedent before we take the leap.
Fair enough. Thanks, Ian. This is very informative. Let's now turn to my partner and mentor, Bernard, who back in 2017 introduced me to sustainable finance. And let's discuss what has occurred in the field of sustainable finance and what might be coming up in the near future. So Bernard, first question, what have been the major development in the green bond markets that you've seen in the last few years?
Well, thank you, Bruno. I would start by saying that the pupil has certainly outclassed the master by now. Very nice to see you today. I would say, we've been involved in various issuance for governments since 2015, 2016. And the main thing, I want to first put in context, I don't know what's my audience here, but just to give you context, in 2016, when it started first quarter, we were ecstatic that about $1 billion had been issued in green bonds, and we were not even talking sustainable. This month was announced that quarterly of 2023, roughly $165 billion in green bonds was issued. So that gives you the exponential trajectory of green bonds. There's apparently, according to CBI, roughly $2.3 trillion of green bonds outstanding right now. So that's the first thing I'd say. Over a few years, we've seen a major market developing a class of assets, as you would say in the jargon, that's here to stay as far as I'm concerned. The second thing is obviously when it started, it was mostly, as you mentioned, supranational benchmarks. So when I'd say supranational, first one was IFC of the United States, and then we saw issuers in Europe, and then we saw obviously the provinces here in Canada, province of Ontario, for instance, province of Quebec. Province of Quebec is about $3 billion right now outstanding. And then obviously the Canadian government, and then we saw also SSAs, not agencies, but public sector institutions like the Caisse de dépôt come on the market. So we saw a broader range. What's interesting is that in the growth, it's not only the major highest standard, obviously they were there to set up the standards and help to set up a benchmark, but we saw a wider range, and now obviously emerging markets came on board, and you have corporates. This happened, I just want to give a little bit of context. I hope I'm not taking too much time. But as you may know, really this is a voluntary-based market approach to developing a class of assets. It was not regulatory. It's becoming regulatory. I think both of our earlier panelists well explained the context in which we're coming into, and I will discuss it. But essentially you have what we call International Capital Markets Association, ICMA, develop guidelines, as well as another group of nonprofit, the CBI, Climate Bond Initiatives, that develop guidelines and certain grand principles. I remember going to some of the earlier conferences to them, and we know what mentioned Ian quickly, set up basically 4 pillars under which you can do issuance of bonds. I see a lot of you know that already, but obviously the green bond framework in which you explain what you intend to use the funds for and how they align with climate goals. Second, that framework must be approved by a second party opinion. And what we discussed earlier, there's groups like Cicero and Sustainalytics, or external independent recognized entities that recognize how green is your program. And at the end, also there's the use of proceeds, and then there's the reporting. Then on a post-issuance basis, those reportings are usually audited by external, usually it's the auditors, the independent auditors, the issuer, that verifies that the use of proceeds were used according to allocation. But this is very much on a voluntary basis. So there's not real definitions by jurisdiction, and that's been what's been growing. I think through the growth, investors have been a major force in asking for better disclosure. They've been also from the asking for a better risk disclosure with respect to use of proceeds. That's definitely been developing in terms of what we see in the documentation. We haven't seen covenants yet, but I'm sure they will appear very soon in underwriting. I'm not recommending it, but I think it's coming. More and more issuers are being subject by the underwriters because of their own liabilities. To that, we addressed it. And dealing also within even the prospectus with certain aspects on a voluntary basis, but once you enter into the voluntary basis, you better make sure there's no misrepresentation. That's our biggest concern right now, because there's no framework on a regulatory basis. And so we've seen the market itself seeking for greater transparency and greater clarity and better definitions of what we mean by adaptation, by CO2 reduction. Those are the main ones. And also, obviously, transition. We're moving a lot towards transition plans rather than just one-off plans. We're seeing the market is really trying, when you do an issuance, exactly to explain in greater details how the proceeds will be used. I think one of the big game changer that's coming up is the European global green bond regulations. And that's been it's about to be adopted by the European Commission and the European Parliament. We see it as being the first regulatory framework, and the big change it'll bring is that in terms of actual documentation from the legal perspective, because right now what we're seeing, from a legal perspective, at the outset was almost like a labeling exercise, to be quite candid. And it has become now a true exercise of the issuer, the corporates, to establish how these user proceeds will actually impact. And so what we're seeing in this is if I can summarize what it'll do is you'll have to make sure that the framework is aligned with what we call taxonomy, that is classification of transition, and we'll see more stringent disclosure requirements in the offering documents that are related to the objectives, and you'll have to be a lot more clear on your environmental impact, the environmental impact of your goals.
Bernard, if I may interrupt you.
Yep.
From what you've said, I take it that we see a move from soft law, from guidelines, from ICMA guidelines, to hard law, to the regulators stepping in and, like in Europe, adopting a specific statute governing green bonds, and especially to regulate the second-party opinion givers, their credential,
Yes.
Who they can be, what they need to do. And you've touched upon the question of the taxonomy. So for us, practitioner like you, like Jason, like me, we're very joyful when we hear this word, and we hope that in Canada there will soon be a taxonomy. The word taxonomy probably doesn't mean much to you, to the general public at least. So Bernard, can you take a few minutes?
A few minutes, I understand.
Yeah, because we're short on time, and I'd like to move to the last panelist. So
Yeah. So, well, I think a lot of you know what it is already. I mean, if I were to summarize it, I think the Canadian Sustainability Finance Group Action Council, SFAC, we call it, best described it, taxonomy can provide a standardized approach for benchmarking economic activities that are consistent with domestic and global climate goals. So basically it means it is a classification of the activities. When you look at it, it's basically a brick this big that explains by items, by activity, by what kind of, to classify itself, what kind of, to classify itself for that particular, what are the targets you have in terms of CO2 emission even. So it is a mix of various elements to classify so people can start to quantify and measure and be able to compare from one element to the other. What are we talking about? I mean, if I were to, and it is, to me, it's as important as what the next big step in whatever we're doing sustainability, which is carbon pricing. It is the ability, therefore, to connect with elements and bring an objective, science-based approach to what we're trying to do in terms of capital raising. It is important because it allows, and the biggest challenge, obviously, I'll go straight, the biggest challenge we're seeing is that obviously various regulations are developing their own taxonomy. China is developing its own, Europe is developing its own, it is the leader right now. And the US is sort of on the sideline waiting to see what's going to happen, basically. That's how we see it. And in Canada, obviously, is right now acting, and I think it's important that these taxonomies align so we can make sure that we have clarity and certainty in the capital markets. On the other hand, we are always subject. Jurisdiction will need flexibility. For instance, Canada, we know that because of we are a kind of economy, most likely natural gas will be part of it, and that's a debate. On the other hand, we know that they've stated in the roadmap that was presented that indigenous people, as it says, that it should comply with the UN Declaration on the Rights of Indigenous Peoples. So we expect that this kind of impact will be taken into account in the taxonomy. I hope that.
No, I think it's a very good summary of what the taxonomy is, and I think tonight before I go to bed, I'll be more educated, and I'll know what the taxonomy is and what SFAC means. So Sustainable Finance Action Council, and be on the lookout because they've published their roadmap at the end of February, beginning of March, indicating that by this fall we should have a first draft of a taxonomy. And you have to know that this is the second attempt in Canada to have a taxonomy. CSA attempted, but wasn't successful. So we're all...
But maybe, Bruno, on that point, the CSA, but not the Canadian
No.
Securities Administrator. There's two CSA in Canada.
The standard
group,
body,
yeah.
not the Securities Commission.
Just making sure.
Yeah, when you buy an electric outlet, it's always CSA approved. Well, that was the body that was in charge of the first attempt. Let's now turn to my the final panelist, my partner in crime, Jason, the co-chair with me of Miller Thomson's ESG and Carbon Finance Group. We've talked about a lot about the public market instrument, Jason, but sustainable finance is not all about public market. It also want to engage with private companies through their borrowing activities. So Jason, what are green loans and how do they differ from conventional loan, and who might benefit from engaging with the relevant framework and principle governing such loans?
Thank you, Bruno. It's a pleasure to be here on my first pandemic trip, and so I made it to Montreal, and it's a pleasure to be here. Our panelists said some things. I jotted down so many notes, so I will answer your question, but if I may distill what I've heard, Olivier, I have tremendous respect for the role that the AMF and the CSA have to play in this global environment in which we know disclosure is here to stay. We know if you get disclosure wrong, you're going to get sued. I say that plainly because we know there is a tsunami of litigation coming, and this is not to encourage you to hire counsel, but it is to encourage you to hire counsel. And if you get disclosure right, there is business to be made. There are opportunities to be made. So that is the platform or the context in which I place disclosure. To Ian, I've pursued my legal career without sounding crass, following where the money goes. And when a $400 billion asset manager says they care about ESG and climate change, we should all care about ESG and climate change because $400 billion is a very big wallet, and we need to be mindful where asset managers and investors of consequence are spending their money. And increasingly, asset managers and investors of consequence care deeply about ESG and climate change. And to Bernard, the challenge for lawyers in 2023 is how do you give meaningful and thoughtful advice about the law today and the law as it is emerging in the absence of global standards and taxonomy and rules that apply for a international phenomenon. ESG is an international phenomenon, and Canadian lawyers have to be mindful of that, and the best lawyers do that, as you are. So to the question of global green loans, we spoke about the capital markets. If I'm an issuer of securities, an issuer of bonds, I access a market for certain purposes. The other way to access indebtedness is through privately negotiated loans. Loans are just another form of evidence of indebtedness. You can issue a bond, or you can go to your bank or your other financial institution and acquire a loan, a negotiated loan. What makes green loans relevant is they're for green projects. And a green project is a defined concept under guiding principles created by more acronyms, the LMA, the LSTA, global organizational bodies that assist in the formation of kind of credit concepts. A green project are projects such as energy efficient projects, pollution prevention, renewable energy, and a green loan is based on a loan that is typically smaller than a bond, done on a privately negotiated basis, and is not sold in a public capital market transaction. Green loans are for green projects. It's a relatively nascent but emerging space. It comprises approximately 10% of the green finance space. But what's important to note is that most global financial institutions, including our esteemed Canadian banks, have a dedicated portfolio of credit for green projects and green loans. And so becoming a green-enabled borrower is important. So is it renewable energy? Is it energy efficiency, pollution prevention, climate change adaptation, green buildings? It's a fairly expansive concept, but the point being, if you're a green project or you're supporting a green project, you can receive dedicated funds that may not be available to other borrowers. And if capital is constrained, being able to appeal to a new dedicated pool of financing is critical. So that's where green loans fit in the larger credit context.
Thank you, Jason. Again, people will think I've got a fixation on sustainability linked. So I will ask you a question about sustainability linked loans. So can you share with us the information about these different loan types, obviously?
Sure.
And the guiding principle and criteria that applies to them?
Absolutely. You asked a probative question of Ian. You know, green loans, the green context has well-known developed nomenclature, objective criteria. We have global banks committing to net zero. We can quantify and calculate green with increasing certainty. We can more easily over time calculate what is sustainable activities, how do we measure it, and how do we reward it. And so a sustainably linked bond or loan, is similar to green loans, but they promote ESG values, but it's not green projects, it's sustainable projects that are ancillary to, but important to, its kind of business focuses of the borrower. So a sustainably linked loan might incentivize the borrower to reach certain sustainability-based objective KPIs, so targets that will allow them to achieve sustainability in their business, but it's kind of broader and a little bit more nuanced than a green loan. A social loan is the S in ESG, supporting marginalized or under-supported or diverse communities. So projects aimed at promoting EDI and other social causes. Most sophisticated and global institutions have loan books for marginalized communities, Black-led businesses and the like. And so there are guiding principles for social loans that are very similar to the green loans. How are you going to use your money? What are the process for evaluation? How are you going to manage the proceeds, and how are you going to report? And the targeted population for a social loan are kind of marginalized or less able to access capital communities. And there are increasingly social finance entrepreneurs who are coming up with creative ways to reach communities that don't get the money they need. The First Nation communities are one. And to those that are listening, if you have money to spend and want to find a community that needs it, there are attractive and profitable ways of doing that. And so a social loan captures that segment of the population that might not historically have accessed capital as easily.
Thank you, Jason. And we see how sustainable finance will percolate down in the economy to the small and medium business, because most of the Canadian banks, if not all, have put in place a framework, and most of them have gone the social framework, so they can issue both green and social bonds. And that means that their loan portfolio, they will now direct the capital towards that kind of loan activity. So for a small, medium-sized business, it will be important to get on board of the ESG movement and get its emissions, GHG emissions down, and adopt a good business practice, because that's the way, that's the door for these type of loans. And the financial incentive will be that the interest rates on those loans will be lower because the risks will be lower for the lender. So that's the theory behind all this sustainable finance. So thank you all for the depth of information that was communicated today. We now have time for some questions. So I will open the floor for a question, and my colleague Leah behind the room will provide you with a mic. So all attendees, as I mentioned at the beginning, can hear your question. So please don't be shy, stand up and wait for the mic. Soyez à l'aise de poser vos questions en français. Je m'efforcerai de les traduire dans la langue de Shakespeare, même si je n'en suis pas un. Alors, the floor is open. So I see that, we have a raised hand here. A brave soul.
Je pense que really. The webinar, okay. Well, thank you very much for this panel, first of all. My name is Erica. I'm a vice president at Milani. We're an ESG advisory firm. And my question is regards to the transition taxonomy in Canada. I'm just curious to know, we keep hearing that it's coming, but there's resistance. Is natural gas going to be part of it? I'm curious to kind of hear your thoughts, maybe Bernard, you're more familiar with it, of what do you think are the major roadblocks right now for it being approved?
Bernard, maybe I want to step in this one.
Go ahead.
Because I was 2 weeks ago, I was in Ottawa at the Canadian Chamber of Commerce annual Day Hill, what they call the Day Hill, and your bus was there, and we had a fire chat talk during lunchtime with Michael Sabia, which you're probably very familiar in, who's now the Deputy Finance Minister in Ottawa. And one of the questions was, because as you probably noticed in the budget, in the federal budget that we got in March, there was absolutely no mention of a taxonomy, which is a bit surprising. And so we asked the question, like, will we get a taxonomy in Canada, and will the federal government support the implementation of a taxonomy? And the answer was very clear, yes, but there was a condition, not without abated natural gas. So there's your answer. Maybe just wait for the mic.
Thank you. So a few weeks ago, I was in London. I think we've spoken, Bruno, about this. I know very little about ESG, carbon finance. I'm a litigator at heart. And the closest I've gotten to it is reading stuff about climate change litigation. But I do represent in my practice regularly London insurers. And when I was in London a few weeks ago doing a presentation that had nothing to do with ESG, it had more to do with cyber than ESG. But I was there for a week, panel like this, changing every half hour, every hour. And despite anything we were talking about, every time you speak to an insurer from London, what they wanted to talk about was ESG. They wanted to talk about whether it's something they need to consider in their policies, how to consider them in their policies, what impact, what to exclude, what to not exclude, what are the regulators doing, where are they going. It was fascinating just seeing how much buzz there was around it. I think buzz is not the right word. It's not just buzz. It's where everybody's heading. So I get to the question that I'm asking. In your fields, respective fields, have you had to deal with insurance-related questions related to ESG, or has that not yet trickled down to your level? All right, do you have conversations like that with your clients on a regulatory basis? I don't know. I'm just asking the question generally. Thank you.
Yeah, I saw that Bruno just raised a public report the QMF published last year regarding financial institution. Just so everybody's at the same page, in Quebec, the QIMF is not only the securities regulator, but to also act as the prudential regulator. So we also basically regulate the financial institutions that are regulated at the provincial level. So my colleagues from the prudential side are also very active on more specifically on climate management risk. And in fact, last year we conducted a survey to all financial institutions based in Quebec that led to a public report about some findings, and now we are reflecting about how our guidelines or our regulation can involve on the prudential side as well. So of course, and that's the value of having an integrated regulator. So as we can advance on the security side, we can also advance our own reflection on also the insurance and the prudential financial institution side as well. So we are very, very active in that regard as well, working with, fellow colleagues from other jurisdictions, other provinces at the federal level with OSFI.
And I would just add that, insofar as federally regulated financial institutions are governed by OSFI, OSFI is looking at leading regulatory bodies around the world. OSFI came out with OSFI B15 guidance. All of the major federally regulated financial institutions will need to be reporting on their climate change risk, identifying their transition and adaptation and mitigation strategies. And so that will include insurance companies. So they're going to have to, in some cases for the first time, calculate and quantify the contributions of their stakeholders and their clients to carbon emissions, and invariably will be imposing burdens on their clients. So it's coming for the insurance companies to be having very demanding conversations with their clients because their regulatory bodies are starting with it. It starts with disclosure, tell us what you're doing, and it ends up with changed practices.
And while you're mentioning it, let me just plug our firm. I invite you to consult our website, specifically the ESG Carbon Finance segment of our website, where we've deposited many, what we call, our newsletter is called Empty Biosphere. And we've written extensively on B15, on green bonds, on ISSB. So I invite you to take a look and you might learn one or two things. I'm conscious of time. We're 5 minutes past the hour. So as they say, time flies when you have fun. I had fun today. I hope you guys also, and you people in the room as well. It was a pleasure to see such a large crowd, and it proves that Montreal is becoming the sustainable finance capital of Canada, and let's keep working at it. Donc, merci à tous à toutes et tous de nous avoir honorés de votre présence aujourd'hui. Et j'aimerais vous rappeler, en finissant, encore une plug, que toute l'équipe du Groupe national de la responsabilité sociale des entreprises et du marché du carbone de Miller Thomson, constituée de plus d'une quarantaine de professionnels dévoués et prêtes à vous conseiller dans vos projets de financement durable. I would like to give a special thanks to our two guest speakers, Olivier and Ian, by offering them a small token of our appreciation. I think I was told that no, maybe not. Anyways.
Coming later.
So disappointed.
Okay. Well, we'll do it after the session, if you allow me. And I will also like to thank two of my partners, Bernard and Jason, for joining us today. I hope you all appreciated And we'd like to remind the audience that Miller Thomson will host its third ESG Carbon Finance event in Vancouver this September, more precisely September 21st. And this time, we will be addressing, among other topics, greenwashing. So stay tuned.